here and pop on. Okay,
Perfect.
awesome. Yeah, we are live today. Little change up. Usually I answer questions throughout the week, but today, privileged to be joined by Emily Miszk from Port Credit Mortgages. Emily and I are actually doing a buyer webinar tonight, and we thought we'd jump on here and go through some questions we got in from Instagram today, and some common questions that typically come on, or at least get brought up, I think, more often than not. So, Emily, thanks for joining me here. And how's your day going?
Today's great. I really can't complain. Got a couple of cookies out today for an event that I have on Saturday, and it's raining now, so I got in before the rain, which is great. And yeah, so these are some of the questions that we get on our seminar, as well as that a couple that have come in over the day, which is awesome. So I'm excited to get started with you. How's your day going?
Amazing. Yeah, day's great. Yeah, we're getting in Toronto today. It looks like it's going to come down pretty crazily. It's very dark and kind of spitting a little bit out there. So I just beat the rain. I grabbed a quick coffee for the afternoon, and hopefully it doesn't rain too hard. So
Perfect.
yeah. So let's jump right into it. We have a few questions, like five, six questions that have come in. Did you want me to go in order? Do you want me to just hammer them out as they came in? Do you have a preference?
Yeah, let's do them in order because I have them in front of me too.
Okay, sounds good. So let's go in order, as order that we have. So this is actually the order that they came in. So
Right.
everyone has them here. So okay, question number one: do online pre-approvals count?
Okay, so there's two types that I would say. One is an online application that you do with a trusted mortgage professional, which is part of my process. So if you were to go and do an online application, submit documentation, and then do a full review with a mortgage professional like myself, then yes, that's a pre-approval. However, if you do what we call a pre-qualification, where you just enter in your information and instantly it's spit out saying that you're pre-qualified for such and such amount, I probably would say no. That's not the best way to gauge a hundred of $1,000 purchase.
Okay, and by the second one, you're referring to maybe just like a random one you find online where you just plug in a few
Yeah,
numbers and get a number at the end.
absolutely.
Okay.
Yeah, because those online calculators don't always know that your purchase price and sliding scale with down payment. It doesn't understand if there's default insurance. It will not take into consideration your current debts. And if you're entering those current debts in, if it does have a field for that, your numbers may not be what the underwriter or lenders will use to qualify. So, for example, your minimum payment on a credit card could be the greater of, let's say, $50 or 2% of the balance. But in standard calculation, we would use 3% of the balance. Or in some circumstances, we would amortize it over a specific period of time. And therefore, the number that that calculator spits out would not be accurate based on how you would be approved at the time of purchase.
Okay. Awesome. So for everyone listening, just so you know, just make sure you know the difference between if you're just putting in the numbers or if you're actually going through the qualification process. And typically, reach out to the person that you are going through the qualification process with, because they're going to help guide you as well. So, okay, number two. Is there a difference between a mortgage broker versus a traditional bank, like as in going into the bank and getting a mortgage that way?
Yeah, so there's a couple of differences out there. One is a mortgage agent, and that is someone that is licensed to be an agent. They basically, you can get your mortgage agent's license and start selling mortgages right away. Then you've got a broker, and a broker can open their own brokerage. They have at least 2 years of selling experience and have taken a second level of designation to really solidify their expertise. That's what I have. And then you have a traditional bank, and a traditional bank has oftentimes no designations. They could just be someone who has, finished school or has been working in sales for their whole lives, whatever the case may be. And they sell all sorts of products. It could be a mortgage, it could be a car loan, credit card, online banking, GICs, Visa, that sort of thing. So they're there to offer their products, and they service many different products at that one traditional bank. whereas a broker has a special designation and they only focus on mortgage sales and secured lending. So I would say it would be like going to a specialized doctor versus someone on the street that has read a couple books in multiple different areas of health in general. So not to say that you wouldn't necessarily get good advice, but it would be advice on a whole bunch of different things that may not be applicable or might not be targeted to your specific need versus someone that is specialized in one specific area of need in which you are going to get to be serviced.
And is there a cost to go the mortgage broker route versus a bank?
Sometimes, if you go to a mortgage broker and there's a cost, that means that you probably wouldn't get approved at a bank. So you would have only that option. But 9 times out of 10, there are no costs to use a mortgage broker. If you do need alternative lending, that would be a non traditional bank option anyway. That would be damaged credit, private lending, that sort of thing. But let's say you're just a first time home buyer or you were going to go to a regular traditional bank, but you called me instead, there probably wouldn't be a fee and I would take you to a traditional bank. It would just be with a bit more of a strategy, service, and that sort of thing.
Awesome. And is there a difference right now? I mean, a lot of the talk these days has been about interest rates. I feel like we can't open the news on a given day without hearing about them. With that, do you, in today's environment, have you been recommending variable versus fixed, or what is your approach to that? Because that's a question I feel like comes up. I mean, I'm sure it comes up very often.
Yeah, so that's probably those are probably the two questions I get the most is how do you get paid? So I'll answer that quickly. That is through the lender that you choose. So let's say you go to Scotiabank with your mortgage, then Scotiabank pays me and I bring your mortgage to Scotiabank. If we take you to First National pays me. So I have no problem with doing pay transparency and having that conversation with people. It's really important that our clients understand how we are paid. So it's not 9 times out of 10, it's not from their pocket, it's from the actual institution. And then fixed versus variable, that is such an interesting question for me. And as you know, my approach is very conservative and it always has been. So I don't put clients in positions where I to know that what the market's going to do. I do not predict. I've never lived through a pandemic before, although I've been in this industry since 2009, 2008. I've never survived experienced a pandemic. I've never experienced, the war that we're experiencing in Ukraine. There are things that I could just never draw on, even though I've been doing this for as long as I have. So what I always say, and what one of our biggest leaders in our industry always says is, clients, I advise and clients instruct. So I can tell you what I usually tell my clients, which is I have a product that allows me to have a portion of my mortgage that's fixed and a portion that's variable. Fixed rates tend to have interest rate differential penalties, whereas variable rates have 3 months interest penalties. And right now, in the past, I would say 5 or 6 years, we see that 60% of Canadians actually break their mortgage on the 33rd month. So that means that more Canadians break their mortgages than not, which means penalties are often higher if they're in the fixed rate terms. So I always advise clients, yes, you can get a fixed rate and know what the payment will be up front. However, if you end up falling in that 60% category, be prepared to pay more. And that then negates the lower pay or rate that you've been paying up front. So we have to look at the overall cost of borrowing and what that looks like. So a solution, if you understand how the interest rate differential calculator or calculation penalty is calculated, it is the loss of interest over the term. That's the simplest way to understand it. So the longer the term, the higher the penalty. For example, a penalty on a 10-year term is very high compared to a 1-year term. So a solution in uncertain times, which I would suggest that we're in, would be to take a shorter term, like maybe a 1-year, 2-year, or a 3-year, and wait that out, have it fixed, and then consider renewing at the 1 or 2-year term. If you ask a client genuinely, why did you take a 5-year fixed? 9 times out of 10, they don't know. And the other time, the most common answer I get is because that's what my parents had. people don't actually know why they're taking the 5-year fixed. They just take it because it's popular and that's what the person that they signed at the bank told them to take. So I always like to say, remember, there's shorter terms available, and a bit uncertain until we get through, maybe in 6 months, 8 months, we can see where we are and reassess at that time.
Awesome. And one thing you did touch on too, and this is something you said, you can shop around to Scotiabank and First National. So, as a mortgage broker, do you have the ability to shop around to multiple options versus, a specific bank? Is that something mortgage brokers do?
Yeah, it's definitely less attractive than I think people think. In the morning, I generally have a spreadsheet that I get sent from all the institutions. It's kind of updated, and we get to see what is out there on a daily basis. We also get pinged with emails constantly with up to date rates. So it's not like I'm in the office being like, hey, what's your rate today? What's your rate today? And shopping around, pulling credit like crazy and sending it to multiple places. In order to maintain relationships, I really just get a spreadsheet, analyze it, go over the options available, and then usually tell my client right there, this is what the two rates are of the most competitive banks right now that have the most attractive prepayments or port policies based on what the client has told me that is of value to them. Here are the two or three best this morning.
Okay. Let's keep going down the list here. That's great. Thank you for the answers are great. So, should you pay off loans, debts before applying? For example, student loans, if you have a car or thinking of buying a car, what does that kind of look like from a lending perspective? And, will it take down someone's, approval or their budget essentially?
Yeah. So it will impact their budget because, each payment for each of these debts does have a minimum payment associated with it. However, I do have clients that come to me all the time during the pre-approval phase and say, do I have to pay this off today? That sort of thing. We don't have to pay off everything right away. I think it's really important that we don't, because that can take away your ability to utilize that for closing costs or for other parts of the down payment or upgrades that you want to do to the home. However, we do need to make sure that we're not adding extra debts after the pre-approval phase. And it's great to play with both options. So what does it look like if you do pay off the debts? What does it look like if you don't pay off the debts? And or what if we paid off some of the debts and maybe re-amortize them? So there are different things that we can work through versus you just going and paying them off before speaking to someone. Some of the debts we assume will have very large payments to them, but for example, OSAP or student loans oftentimes are really low payments. And it doesn't actually make sense for you to pay that off. It would be more advantageous for you to use that money towards your down payment or even towards closing costs. So I would say before you go and pull the trigger on anything, speak to a mortgage professional, mortgage broker to go over all options first. And then really, it's generally speaking a condition of the agreement that you sign with the lender that it has to be done, let's say 15 days before closing. So even if you were to make an offer today and they said we need these paid off prior to closing, that could often be 90 to 120 days from now. There's no reason for you to rush and do it now versus taking care of your deposit or that sort of thing. So I would say definitely loop in your professional to see and figure out what would work best for you and your family versus just rushing and doing it without consulting.
Okay, great. And last one, something I guess we heard today. Do you have any, if someone wasn't looking to like go on the internet, plug in some numbers, like do you have like a general kind of, let's say, very basic general calculation of like what they could possibly qualify for, just from a like
Yeah,
if I make X
I
dollars, what
really
would
don't like doing this because, full disclosure, it would be like going, I always say this example in our meeting, when we do our sessions, that it would be like going into a doctor and saying like, I think I'm feeling sick, but I'm not going to do any blood work for you. And they're like, okay, well, why don't you let me check your blood pressure? And you're like, no, can you just look at me from afar and tell me if it's cancer? Like, can you just tell me from over here if I look sick? No, not really. I need to do a full analysis of your financial history and go over all of your documentation to really assess you. However, if you want a really rough, I'm talking super duper rough estimate, you can say 4 times your income plus your down payment minus any debts you have is a very rough estimate of a qualifying purchase amount. But that's super rough because
Okay.
you could throw in poor credit, good credit, yeah, down payment history, minimum payments, amortization, terms, stress test, bad luck, good luck.
No, I think it's good to know because sometimes, I've heard it sometimes where someone's like, I make X amount of dollars. I think I can qualify for this. And that gives a really clear picture that like, it's not always as cut and dry as that. So just based on a,
Right.
hearsay on what could be the possibilities. So does anybody, we have a few people still left on live. Does anybody have any questions for Emily?
I think while we wait, if I can just kind of reiterate with the fixed versus variable, I have my feeling towards it because I am conservative, but I am a tad risk adverse. So it's a balance. I think what you need to do is have a professional that really knows the products and the features and go over them together. And at the end of the day, it becomes very clear to that person if they're comfortable with variable or not. Most of my clients go fixed. The bulk of my first time buyers, almost all of them, go fixed. Most of my repeat buyers right now are going fixed. There was a time where variable was very popular. And I believe, and I know historically clients save more on variable, but the uncertainty is something that a lot of people do not enjoy.
Great advice.
It has to feel right.
Yeah. Okay, so I guess if no one's got any questions, I mean, Emily, thanks for joining me today. It's nice to have someone else on here other than just me talking to a screen. So have an awesome day, everybody. We are doing a buyer webinar tonight, 7 p.m. We're going to answer tons of questions, go through the process of buying, and basically some of the stuff we broke down today or Emily broke down today, we're going to just unwrap some of that stuff too and go through the process. So if you need that link, it's in both of our stories today. It's on our link in bio. And yeah, hope to see you there. Have an awesome day. Thanks, Emily.
Have a great day, everyone. Thanks so much.